Hello, everybody. Give me a second here. All right, whatever. All right. All right, let's get going here. Had some other issues with the social media channel, but let's do it. So today, smart money side of the trade. Don't we all want to be on the smart money side of the trade every day? Well, some trades are easier to depict that than others. Of course, it comes down to a trading plan. But today we're going to be talking about credit spreads. And while they are let me back up. They're all easy to figure out, right? The problem is with all of us, you, me, and in part what's happening right now today, the last several days actually, where this sideways price action is occurring, which is great for credit spreads, but it stinks for directional trades because they're directionless. So the problem, like I said, is us in that we don't get the setups that we want at the moment that we're looking for them. And so we can use different vehicles to make money from. And so credit spreads are one in which directionless is fine. If it goes in the direction other than the one we don't want it to go in, well, everything is great. So the thing is to understand what we're dealing with. And the way we deal with them is from the point of view of starting with a chart, whereas I'd say the vast majority of those that teach credit spreads, they do it from what's called the Greeks. And we've always been from the point of view, if you're going to do any options strategy, credit spread, buying a put, buying a call, debit spreads, without a chart, the analogy of going to a gunfight with a knife, applies. So let's review and then we'll look at some examples.
All right. Good afternoon. And if some of you didn't follow Greg's intro, don't worry, because Greg, you kind of skipped over the basics of what even a credit spread is, but obviously we're going to get into that right away. So in a few moments, you will know exactly this type of strategy that we're talking about. Always start on this slide. Why? Because it's our approach to trading anything that moves. Stocks, options, currencies, Bitcoin, doesn't matter. And even options. Options are a derivative of the underlying, which means the price of the call or put option, we'll get into that more, is based on the underlying. And we're going to make money based on our bias of the underlying. So everything we do at Master Trader is chart technical analysis based. So the more you know, and have taken Greg's course on his MTS course, the better option trader you're going to be. So this is our starting point for trading, the equity or the ETF. And then today we're going to talk about how we're going to be selling options on these patterns to make money. Just as Greg said in the intro, we're just picking a short-term top or bottom, and our goal is to keep the money. It's that simple. So the starting point says I need a compelling pattern, bullish or bearish. Where is it in the trend, support and resistance, multiple time frame analysis, relative strength, weakness, what are the broader markets doing? And then obviously proper position and money management, trader psychology, got to have a trading plan, trading options also, money management, trading options. Obviously, we'll get into that when we show you the charts. So this is our starting point. A couple basic definitions now. So I said an option is a derivative. Tell me more. Okay, here's the definition. So when I buy a call or a put, it's giving me the contractual right to buy the underlying stock or ETF if it's a call option, or to sell or short the underlying if I'm buying a put for a specific time. So these are time wasting assets. And that's why when we're selling these options, we're flipping that time decay component that hurts option buyers is helping us as option sellers. And when we overlay our technical approach, saying that's not going there, that's not going there, you'll see why we love this strategy today. And that's for specific price. That's the strike price. The premium on the option table is quoted as if it were per share, but the minimum of one contract represents 100 shares. So when I'm buying a call option, this is what we call, and we teach it and we do these, and it's a great strategy, but that's a directional strategy. If you think Apple, broke out the other day, which it did, you could either buy Apple or you can buy a call, because as Apple goes up in value, your call option is going to go up in value. We're not talking about that today. This is what we're talking about. On bearish patterns, we want to be a call seller. So we're taking the other side of the bet of the option buyer who thinks something's going up, and we say, well, that's not going up, I'll take your money. That's a naked call. We'll get into spreads when we look at examples. That's for directional. I won't get into that. So now if you buy a put, I already discussed it, that's a directional strategy or hedging strategy, but your bias is you think the stock or ETF is going lower. If based on our chart analysis, we say that's not going lower, that's a candidate for us to sell a put or a put spread, keep the money. We'll go through our checklist and show you with many examples how we do this. So those are the definitions. We set the groundwork. Here's just another slide discussing it, why this is such a great strategy. Earn weekly, monthly income from time decay. And as Greg said in the intro, this is a great way of saying it. And that's why he said it doesn't have to be a directional setup. It can be slop, 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 but we're looking at the pattern saying that's not going down anymore. So we're getting paid to put that bias on the line by selling puts under support or calls above resistance. And day by day, those options decay in value. That is unrealized gain to us day by day through the evaporation of the value of that. Charts are eggs. You don't have to time them. They can. It's like you don't need to be perfect with your entry as you do with directionals. We like high implied volatility. So when we get multiple day sell-offs in the market and we get our market internals at bullish extremes, this is an amazing, we clean up on selling these put spreads around turning points on support, high volatility, because then we also are making money as that volatility subsides. Our unrealized gain is also going up. Trade management, that was on the first slide, right? We're in a trade. How am I going to manage this thing? Well, we're going to manage it with the charts, taking partial profits. You can let it expire worthless, but we use stops. In my full course, I teach adjusting strategies, hedging strategies, rolling strategies. And you can do this regardless of what the broader market's doing. Greg, what are the only three movements of stocks? Right there.
I don't see
Up,
them moving at all lately.
up, down, or sideways.
I guess sideways for the moment.
So on this strategy, stocks go up, down, or sideways. For you to buy a stock or an ETF, you will only profit penny by penny if it moves in the intended direction. This strategy, we have a calculated, by definition, we're going to win 2/3 of the time. Let me explain that. So let's just take an uptrend, higher highs, higher lows. And we can sell credit spreads in all three of these. A bull put credit spread, so we're going to sell a put under support. We're going to take part of the premium that we received on selling that put. We're going to buy a further out of the money put, and that's what's called a spread. And that's our potential maximum profit is the premium received. It's immediately deposited into your brokerage account. So based on this little introduction already, how do I make money? Based on the stock movement. Well, I don't want it to go under the short strike support. So I make money if the stock goes up. I make money if the stock just chops around sideways. It doesn't have to move. And I can also make my money if it goes against me, as long as it closes above my break-even point, which is what? The short strike less the premium received. So just by definition, this has an overwhelming odds of success over directional trading. Now, as Greg also said in the intro, the reward to risk is off because our potential maximum gain is the net premium received. Whereas the max loss is the difference of the spread less the premium received. But let's get into, so opposite for bear call credit spread. I like to say it gives us a cushion to be wrong, and we still make money.
What does that mean, Dan?
Well, it's what I just defined here, that my break even point is far away. Whereas when you buy a stock or an ETF, your break even point is the price you just paid for it. So
The credit you received is your cushion.
Well, it's more than that. It's the cushion. It's my break even. So it's the difference between where the stock is trading and my break even. Right. And so we get testimonials, which I love, when people say the stock went against me and I still made money. And you cannot say that on a directional trade. That's just another pretty way of describing what I just said. So these are 7 beautiful bullish reversals. We want to see where it is in the trend, multiple time frame support and resistance. But again, the starting point is I have a bias that it's not going under this particular level on this pattern. Then we go to our checklist, which is, what am I going to get paid for taking this risk? Go to the option table and see. So this is my short strike under support. What are you going to pay me? Step 1, you have to make sure the options are liquid. And that's like one of the biggest reasons that, a trade idea setup is a veto. Wide spreads, move on. So I have tight spreads, I have a nice credit, and then I'm going to take some of that money, because we favor spreads over naked for 2 reasons. It's less buying power required at the brokerage firm, less max loss if you have a big gap against you. I have a defined max loss of the difference of the spread price. And most of ours, I'd say, are $5 wide, just most of them. So it would be $5 a share less the credit received. But if something gapped down $20 on you, my max loss is what I just said. And if you're long the stock, it just gapped $20 against you. Uh, this is a slide, I'm got all worn here, but and we've done one of these MT lives called, the top 10 fallacies of option trading. So I grabbed this slide out of that one. And so this is one of the myths. Only fools sell options because the risk dwarfs the potential gain. Well, I showed you how statistically 2 out of 3 directions it's in my favor, time decay is in my favor, our directional bias is in our favor. Think of an analogy is an insurance company and a casino. They're collecting money all day long. All day long, they're collecting money, selling insurance policies. And yeah, you're going to have to pay claims. That's the business that we're in. But it still has an uptrending equity curve, even with the drawdowns of stopping out. Condors you can do in range bound. So let's now, with that background, let's look at our beautiful chart examples. And feel free to ask questions as always. Here, I don't have this up, so I can see questions. All right, let's get Greg involved here. These are our daily charts, very simple, no fibs, color-coded candlesticks. The blue is 20, green 50, red 200. They help speed the analysis. Remember, step 1, I want a bias that I don't think it's going above there for call spreads. I don't think it's going below here for put spreads. So here we go, Greg. Right here, and then a gap down. What's your technical? Let's see, we could, I'm not even getting into the discussion today of directional. Should I have bought, is this a good enough pattern to buy a put? I'm not talking about that today. I'm talking about, look at this red line. So that's $95 call strike. What is your confidence level, Greg, on this gap down where the arrow is, that this stock ain't going back through all this resistance in a couple of days?
Every credit spread I suggest or we do, I believe it's not going to go there.
Right, but we're here teaching, so why did we do it on this one?
Well, the pattern supports that bias. It moved lower and it tried to go up and it didn't. And now it's moving lower.
Correct. So
I mean, it's this simple. This is this. Let me cut to the chase, and we could look at plenty of examples. But let me tell you something. This is the easiest technical setup to understand and take advantage of credit spreads. The real magic comes in the management of credit spreads. Because if they're working, right, it just works and there's nothing to do. Right. So in this example, you have a situation where you've got this rounding top and prices start moving down bar by bar, it moves down. So it's just like a no-brainer. Like an idiot could do it. But when we get into situations where, let's say, something like this happens, I'm trying to get my little drawing stuff out here. Something like this happens on the next bar. You see where I'm going, folks? You're welcome to type in there, but let's for the moment do this. Right there was the pattern. And it's like we're looking at that and it trades under the bar and you've got that rounding top and now you're looking at a big green bar. That bar suggests it's going to go up, which now creates, think about the thought that it creates. That's how I like to explain what we do with technical analysis without indicators. And we have a concept called bar by bar analysis. So now you've got this bar that implies that it's going to go up. What, right, John? It gets your attention with a credit spread. Why? Because you are in a situation that this instrument The reward to risk is not good, but the management, as I said, is the magic and how to handle that and what do you do next? And that is what Dan does very, very well with the management of these credit spreads, because this this there's nothing to do. It's just doing what you believed it's going to do. So with everything that we do, whether it's a credit spread or whether we're buying XYZ because we believe it's going to go up, new information becomes available to us from what we base that decision on. So in this example, it's perfect, right? Nothing to do. But if we get the big green bar, how do you do it? Because there's a balance. There's this balance between where I started, meaning let's just call this chart the big picture of where I started. There's nothing wrong. I still believe that this is a good credit spread situation, and it's not going to go up into that area where it's going to impose some pain on me, financial pain, meaning lost money. So there are these situations, I call it a situation where it really hasn't gone wrong yet, but it isn't going totally right either. And we all deal with that no matter what we trade, because there's this period of, I think it's okay, but I'm not so sure it's okay. But do I kill the trade here or do I wait? And that's the gray area with technical analysis that we all find difficult to deal with. And because there's not a black and white thing. If it hits your stop, it's black and white. You're out. Move on to the next trade. So with credit spreads, it's a little more difficult, in my opinion, because that gray area, let me back up for a second. The gray area when you're trading something directionally, it's like, you know, I know where my stop is. I've calculated the share size and it hasn't gone there. And if it goes there, I'm going to get stopped out. Now, with credit spreads or directionals, if it gaps against me in a big way, say an earnings report comes out, that could be painful to me regardless of what I'm trading. Sometimes with a credit spread, if it's going to, well, when you do these credit spreads, Dan, on earnings, that gets into another situation where the premiums are so jacked. But in a normal situation, the credit spread is going to be quite painful, and there's nothing you can do about it because it just comes with the territory of what you're trading. And the unknown is always the unknown, and no matter what you're trading. So with a credit spread, it's going to put a pretty hurt on you. And so, but if it's not the black and white, meaning I drew that green bar, you know, and now you've got this green bar there. And it's like, will it go up there? Nobody knows. So the management is really, really a key part. And Dan covers that in his management mastering credit spreads course on how to manage it. But like with everything that we do, you need experience in different market environments. And that's why, like the technical analysis course, swing trading or bar by bar, really enforces all of that for you to be able to do this on your own. And that's truly the key, to be able to interpret the price action on your own and make intelligent decisions. And let me a little bit more. I'm going a little off
Yeah,
the
no problem.
subject here, but
Perfect.
it's good information in that this is something we all deal with. And I didn't mean to get into a psychology part of trading, but it truly is, where you have, and explaining, the credit spreads. Whereas you can be in a direction trade, and it's like, I think that not working out, and you kill it, and then it goes in the direction that you thought. And you're like, damn, why did I do that? And so there's this element of just letting it do whatever it's going to do because you got your stop in and so on. And so with a credit spread scenario, there's that fine line that if I let it go and do whatever it's going to do, it's going to kick my freaking ass because of reward to risk. And so you have to learn this balance, which Dan is really great at, of saying, you know what, enough's enough. I'm killing it. I'm going on to the next trade. And it's something that you really, really have to learn. So with that being said, you've got a greater grasp of what we're dealing with this particular instrument for trading. And as we look at these examples, I think as you internalize what I just said, you're going to get a lot more out of it. Let's continue.
Yeah. So in this example, we obviously did a $3 wide and we took in 65 cents a share. So on a 10 lot, that'd be $650 immediately hits your account. This was easy to manage. We just went into trail mode on this little gap, probably moved the stop to the 30-minute high on to the next trade. And that was Target a couple weeks ago. This was Netflix a couple weeks ago. Big W bottom, right where the arrow is, over the high of 1, 2, 3, 4 bars after new low reversal. I don't think it's going to go under 1095. So we take some of that money. We bought the 1090. Here's my default $5 wide. Took in 70 cents a share, $700 on a 10 lot. You can go up, down, or sideways. And you can even go against me a little bit, right? Because let's just eyeball this. Let's say the stock was at 1105 when I entered it. So Greg, here's a good example of the word cushion, right? If I entered it at 1105, I have a $10 cushion before, it can go against me $10 and I still make my maximum gain.
But you do have that emotional
What?
stress, which
No, no,
comes
no.
with being human.
No, I'm talking about at expiration. Of course, you're
Yeah,
going to feel pain in between.
right.
Of course.
Right. Which is, any trade that we do that isn't doing exactly what we believed it would do in the moment creates a little emotional uneasiness.
And
And learning that balancing act is really a key part of any trading, credit spreads or not, but credit spreads add a little bit more, you know, leverage or twist on you.
and so it's a good time to bring this up then. You might have alluded to it, about pain, etc. So let's say let's say 5 minutes after I entered this trade, it goes against me. News came out. Very often for like trade management, um, we took in 70 cents a share, right? So very, very often I'll put the stop loss under support based on the price. But I say, if the debit to close this becomes 1x of this, so what that means is if what I took in 70 cents now is $1.40, I'm at 1x my loss. That's it's just a rough rule of this should not have happened. It should not have doubled against me after I entered it so quickly. Something's not right. And you can just kill it at $1.40, and then you've lost 1-to-1 is all.
Let me expand on that. It's a
Sure.
it's a it's a key point to understand as we're talking about credit spreads versus um, trading directionally. So you're long XYZ. And so as we do everything, it's based on the chart. So let's just say, for example, with this particular instrument, I am going to, I didn't want that. I am going, I'm going to go long XYZ. I'm going to be buying this stock for this pattern. And I'm saying I'm going to put my stop down below this area and I'm going to risk $300. And the difference between my stop and my entry point will dictate how many shares I'm going to buy. And so if it goes down there, I lost $300. Fine. I predefined my calculated loss. Now, if I'm going to do a credit spread and the difference between the strikes is, say, five strikes, and I'm going to do a certain amount of contracts, well, I've already defined what my maximum gain is, and I've defined my maximum loss, but the loss is way bigger. So now that opens up that door to what Dan was saying. I'm going to risk 1-to-1. Now, if I did the directional and I said, you know what, I'm just going to risk $300, but it's not based on the chart. I could lose $300 and it be meaningless based on the technical analysis part of it. Whereas with a credit spread, you're saying, you know, that distance between the strikes, that might be in the same instrument here based on the cost of those options. And correct me if I'm wrong, Dan, might be $1,500,
Yeah.
right? But if I see a bar that makes me question this, and you might say, well, Greg, define the bar. Could any red bar could make me question it? Well, no. If it's a little red bar, not a big deal. But what if it's a big, nasty red bar? That's much more convincing that it's going to go down and create that nasty pain to me that a credit spread could happen. So there's this judgment part. You're not wrong and you're not right. So that judgment part is really difficult. And so there are times where it's just like, you know what? It's just not going my way. So let me step aside with the credit spread. Whereas if I'm trading it directionally, I could say it's really not going my way, but I'm just going to hang in here with it because I'm dealing with, I know what my loss is going to be. And sometimes big red bars can be ignored. So I'm willing to take that risk with a directional trade, but I'm not willing to take that risk with a credit spread trade. So you've got a different mindset. Credit spreads come with a bit of a different mindset than if you're just trading XYZ directionally. And part of the advantage of the advisory letter is that the updates Dan does in Telegram and the videos he does at the end of the day. And so you get explanations of what you're doing and why you're doing it. You're learning while you're earning. So that
I like
sounds
that.
pretty neat, right?
I like
But
that.
right. But you're learning while you're sometimes getting, you know, a little, beat up there. But the whole point of what I'm saying here with this management is I'd rather lose a pinky than a whole arm. Credit spread could inflict some serious pain because of the nature of the instrument. It is what it is. So management is such a key part of what you do with these things. So look, I'm going to toot our own horn and what Dan does is great with this management. And we pick these things based on the chart. That's MTS. But you go to some of these webinars where somebody tries to tell you, oh, it's like free money. They're going to put the money in your account, and all you got to do is wait 3 days or a week, and this and that and the other thing.
Right.
And
And roll,
meanwhile,
roll forever.
yeah, you're gonna roll it forever. I love that thing. You got to bring it back, Dan. That hair bay,
Right.
that bale of rolling downhill on fire, where you just
Right.
get your accounts getting destroyed because these people that don't use charts, they just roll it into the next expiration. Before you know it, you're just dealing with a nightmare of giant proportions. So let's look at more charts. But
Right.
I hope
Yeah.
you're getting something out of this discussion because we don't always go there with these, but I felt it was necessary.
Um, Greg, tell them M top, no brainer. Did it on the gap
Yeah,
down.
right. So you look at these patterns, and so the thing is to understand the patterns, what we're dealing with, and you've got this accelerate. It's really common sense, right? You got this accelerated move to the upside. That makes me think it's not likely to go much higher in the short term. Now, you every technical analysis that we do creates a belief. If something's in an uptrend, I believe it's going to continue in an uptrend until it stops. Okay. Well, there are transitions. And so while it transitions, and this is what this is, where we see something that, with, what is this highlighter? When we see something that begins to stall, it stalls and it pivots. And then it does a retest. And look at this bar. Tell me that bar there, what you see. Let me clean that up. You see the significance of this bar that I'm pointing to right there? Little pop quiz. It's very important. It's a topping tail. But what else, Robert? It took out the high of the prior bars. These bars, it took out the highs, which means it was rejected. This is the real magic in what we do in bar by bar analysis and trend analysis and putting the bars together, in that when you view it in that way, it's like, okay, it was in an uptrend and it pulled back to support and then it retested, and this bar tells me that buyers came in and took advantage and knocked it back down aggressively. And so now as it starts to pull back here, you you might say, you know what? Why don't I just short that? Well, you could, and maybe it keeps going down. We don't know. It's a little bit more of an unknown as to whether I might say, what do you think about the possibility of it not going back there?
Yeah,
This is your credit spread.
that's a great way of saying it, Greg. But how confident are you that this is going to keep going lower? Just answer yourself, 1 to 10. How confident are you that it's not going back above this red line for 3 days? And so you see the overwhelmingly more confidence on the latter.
Right. Yeah. And so this is what we're after with credit spreads. That's what you should be after with a credit spread. And understanding what I explained about the technical analysis part without indicators, bar by bar analysis, retest reversals, it's extended to the upside. And then we can start adding elements of relative strength and weakness, what sector it is, into market analysis, market internals, where's the market at, and all of these things that we look at to come together to formulate an opinion, and then a trade allows us to look at something with confidence that, yes, I'm dealing with an instrument called a credit spread, that the reward to risk is not skewed in my favor. But if I put the odds in my favor with technical analysis, my batting average is going to be great. And if I contain the losses effectively, I'm going to do very well. And what Dan is showing you now is the results of the options letter, right, which we send out, and
Last month, yeah.
it shows you how many trades, how many were winners, how many were losers, what's the batting success rate, ratio or rate is your batting average. And so total gains, total losses, right? And total gain or loss. And there's the proof of what I just said, is what we're doing now. As you can see, there are losses, but if you're going to be a credit spread trader or any kind of a trader, it's going to come with losses that have to be managed. Right? And
Yeah. Go ahead.
yeah, I mean, look, we're not here to tell you that, every trade is going to work. It's not.
If you hear anybody out
Management.
there saying they got 99% batting average, they would have billions of dollars thrown at them to run an ATM machine from hedge funds. So you use a little common sense. Just remember the hey, I have a pill for you if you don't, want to lose weight and don't want to diet, then go to the gym. Same thing.
Yeah,
Let's just show them a couple zero DTE examples because we're getting late here and we always save time to do some scanning together.
sure.
Um, so that we love, and this is we do it. Greg gives the levels in our green room, which we broadcast on YouTube starting at 9 a.m. Eastern time every day. But the index ETFs have daily expirations, other than diamonds for some reason. And so every single day is zero DTE possibility. So we love these and we can't wait for the day that they do a pilot program with the top 20 liquid stocks that we could do zero DTE on those also, and that's going to be phenomenal. So here's a zero DTE, 15 minute spiders. This was pre-market. This is an end of day decline. Pre-market gapped up. It's rattling around. You can see the market open right here. Boom, went sideways for an hour, 4 bars, right? 4 times 15 is an hour. Right there, sold an out of the money put spread. And somebody asked me this in the green room today. How wide do we go? On zero DTE, I go as far down as possible to only pay a penny because they expired today. I don't care how wide it is. So this one we took in 51 cents a share, W reversal. See that this is a closed trade. All our trades are in the members area, open and closed. This tells you, as Greg said, you're learning while you're earning. W reversal 15-minute using pre-market data. This picture, a huge void, expect stabilization after yesterday's sell-off. And then now we're in management mode.
As long as it doesn't go back down there, like I explained before, just sit there and let it evaporate.
So this was Amazon's earnings last month, and we love selling options right after the earnings announcement because even though there's a lot of volatility crush, they still remain elevated. In fact, we did we did one on Marvel today. It was a novice gap on earnings, and we sold a out of the money $5 call, and we're already at 50% of max profit in a couple hours. But this is an amazing bullish gap on Amazon, and now that's the daily. Now we're just patiently watching it to see if it sets up for a call spread. 30-minute low, right? 2 bars, 30-minute low, sold an out of the money call spread, took our money in a couple hours. Um, so this mastertrader.com/weekly options is our weekly options letter. We only sell options. We give trades exactly like you're seeing here today with the telegram, the alerts, the spreadsheet in the members area. And primarily we focus on 10 days or less, even 5 days or less, because you get the more rapid depreciation of that premium. Last chart here. This is McGraw. He's been trading 30 years and he loves selling zero DTE. He came and learned our technical approach and improved his batting average phenomenal. And look, this was his, we'll read it here yourself. Much higher percentage. This old dog has learned new tricks. And this was his month. Look at this, 62 out of 64. Look, remember I said, like an insurance company, you're going to have to pay a claim. I don't know what happened this day, but he's not lying. There's a big butt kicking, but he's still up 91 grand for the month. All right, condors we won't get into, but yeah, Greg, give them your quick little spiel and then let's look at charts.
I think it's holiday, Dan. I don't think it's holidays, but I'll give them the actual link.
No, it is. I've tested it.
Okay, cool. So look, the weekly options letter is like $49 a month. It's, ridiculously small amount for the amount of education you get and the trades and the guidance and so on. So it's a no-brainer. If you're interested in trading weekly option credit spreads, subscribe to that. We don't discount it because it's so low to begin with. But if you're interested in courses, we have bundles, the end of year specials, where you can get three courses. They're bundled together, which is what Dan has here. This is the bundle for, I think that's options. This one here is the courses. So if you've not taken any of our courses, I would suggest you buy both of those and you're set for life. Um, and here, look, those so many of our subscribers sign up for the year for the green room and the advisory letter because it's ridiculously inexpensive. But I think it's like $1.60 a day for the green room to sign up now this time of year annually. And I think this is about the same. I think it's actually a little less a day for the swing and advisory letter. Um, so great services. The advisory letter, you get the sector analysis and market timing and trades. And um, either letter comes with, the videos and updates and text messaging. Um, so check that out. You can get the courses separately if you're interested. They're individual courses that, if you've got, let's say, the swing trading course and you want to get the money management course, everything is discounted, right? This time of year, holidays and so on. So check that out. And I'll just drop the link anyway, just to be sure. Oh, I
Yeah,
already did that. You got it. So let's look at a few examples. We have some time here.
and yeah, remember Thomas emailed us, wanted to look at the quotes to show them examples. So maybe just pull up whatever spiders, um, just to well, whatever stock you find. Yeah, we'll just show them the premiums.
All right. So what do you want to look at? Spiders or
Yeah,
what?
just because we do zero DTE on that all the time. Sure.
All right. All right. So you got four time frames up here: daily, weekly, 65-minute, and 5-minute. And things have been directionless here for like 4 days now. It's kind of ridiculous. Um, so I mean, if it closes like this, that would imply it's going to go up tomorrow. But what we'd be looking for, zero DTE, you look at the quotes, and this didn't change the spiders because let's see here, 16 days,
Or
zero. So they're zero. These are expiring today. These are expiring today, puts and calls. And I doubt there's any premium. A no-brainer would be down below, yeah, today's low at 680. And so you just go and you look at 680 and you say, oh, it's 11 by 12 cents. That's not enough to do anything at all. You wouldn't even be worth selling it naked. But
right,
we could look at, and because things are just going sideways, there isn't going to be much premium. Things aren't moving. So that's the bottom of the range and the top of the range. And so credit spreads when things aren't moving like this, but what would have been great to do would have been when this was running up, like here when it gapped down on this day to say, hey, can I do a credit spread up above this area, which is above that high?
yeah,
That would have made more sense
and
because
we
it's run
do.
up. And when prices are running higher like that, you know that they're going to be juicing
Right,
the calls because
calls.
people are
Right.
buying those calls. They're gonna make more money as they're going up. Uh, and on this day here, I had pointed out pre-market that I think this was the Friday. I think it was the Friday that there was an overwhelming amount of calls being bought versus put call ratio, and historically that has led to a correction, meaning, and when I say correction, most of the time we think, oh, it's going to pull back because it was going all the way up. Well, so far it hasn't pulled back. It's going sideways. So this is what's called a correction through time. And at this point, it implies to me that this is going to go up tomorrow. I don't know if there's any news coming out, but it implies to me, based on this price action, if it clears these highs, it's going to go up. And that would be the bet that that's what it's going to do. Um, Now, if we look at SPX, right, it's based on the same instrument, but that's a different animal.
Yes.
Right? So this might have premium. I don't know, but you can look the same thing. And now this is why SPX is more attractive for zero TTE. It gives you more opportunities. And so you say, well, what if we can find something at 68.25, since this 65-minute chart's got a bottoming tail bar and there's two tails here. I doubt there's anything down here, but we can look. This would be the process. So we go and look at 68.25. There's some juice there. And so what if we went a bit lower, make it a no-brainer? 68.05 down here. So now you go to 68.05 to get enough premium, right? Just say we want to get 50 cents. I got to find something for 30 cents. I got to go quite wide, which creates more risk if you're wrong. But the probability of being wrong based on this price action, I believe, is low. Now, you want to get something tighter, which is a choice, and you went 68.20, right? $1.25 by $1.30, and now we can go to like 68.05. You can go like 15 wide. But trying to get something 5 wide is going to be, well, you got to get closer to trouble. Okay? So in my mind, down here, virtually trouble is non-existent. That doesn't mean 100%, because news could come out and you could get a fast move intraday. But based on what I've explained, this sideways price action, like any credit spread, you're looking at what's the probability that it's going to go down there in X amount of time, which would mean not tomorrow, not Friday, in the next 3 or 4 hours. And you know what? Even if it goes sideways and chops around here for 3 hours, that premium is going to evaporate. And that's the melting ice cube analogy.
Yeah.
Even if it doesn't move, that credit is going to diminish in value. Those options are going to lose premium because those traders that are betting that it's going to go down here, right? That's what this is. There are traders that are betting that this will go down there today. Maybe they're hedges, but it's a bet, right? That it can go down there today, and this 90 by 95 cents would become very valuable. But based on this pattern, what is the probability of SPX coming back to the bottom of the range? And so you come to a conclusion, as I would say that's relatively low. Why? Because of the price action that it's getting bought. And you can see that bottoming tail bar in the 65-minute, and then it was retested. And this is what the technical analysis course reinforces: the technical analysis, how to interpret that. This is a pivot, and it happened in the area of this congestion. So there are buyers there. It created support. I believe there'll be buyers there again. Now, it's not a kind of a pattern I want to trade. It's too erratic, but I just believe that it's building a support area. So as it does that, and I look at the daily chart, it leads me to think that if it closes like this at 4 o'clock, it's going to go up tomorrow.
Mm-hmm.
And it shouldn't go back down here. Now, even if it opens up a little lower tomorrow, there still should be buyers. So the theme of what's been occurring over the last couple of days should continue unless something really shocks traders, which could be It could be news, but that's the unknown. So why even think it? All I could do is look and see if there's any economic reports coming out, something major. And even if it does, how major is it? Well, the only thing that could be is a Fed announcement, but look, relatively to different risks as far as news, I think that's relatively low. And the evidence is that you can see they keep buying down at these support areas. Right? So we could then apply that to different instruments. And you can see here in this layout, we can see what's doing well on the day or poor on the day or the week. And we see, energy is doing well, which loads up those stocks here. And then I can see which ones are doing the best, or when I've got this is sorted for wide range bars. And we could start doing the same thing. These are not going to have zero DTE, but as we start looking for different instruments like this, we could then start looking at, credit spreads as well. And this has only got monthlies, but you get where I'm going. Here's a bottoming one. Right.
It, yeah,
Staffing, 108, right, $110.
it was too
It's only got
spreading.
monthlies.
Yeah, we looked earlier.
Yeah. But this is the gist, the overview of credit spreads and how we do it using technical analysis, coming to a conclusion as to I don't believe prices are going to go here or they're going to go there. Then we go look at the options table, and then we decide if there's a trade there. And this is what we do every day. And then if you're a weekly options trader subscriber, it gets text to you in the moment with the management as to which ones to do, which expiration, what's the stop. And then as it's managed, you get the updates text to you as well as to, hey, raise the stop, take partial profits, get out, take the money. And that's it. Right. Find the trades, manage the trades. And as a subscriber to the letter, you know, just the information that you get, and you learn while you earn, and you manage the losses accordingly. So all the best. We will be back next week, and we're going to send out this recording. But one of the things that we didn't mention was MT Weekly Advantage, which I don't have the link for, but it's on the website. Maybe I can get the link here. And you get the history of uh, the MT lives and trade reviews and lessons. This is a great product, really great product to consider. And for 37 bucks a month, it's another no-brainer. Anyway, I hope you enjoyed this. Give us a thumbs up if you're on social media, and we'll be back next Wednesday. All the best. Bye-bye.